the Bank of Japan and its new policy really putting the brakes on what could have been a historic run for the Dow. How do you see it impacting the market day ahead, keeping in mind the Dow futures right now up fractionally?
Yeah, I think that this is a story that's going to play out over weeks and months and not days. But of course, the shock of having the Bank of Japan come away from a long-held policy of yield curve control is something different that the market's going to have to digest. But the bigger story that's been going on is that the data for the economy globally and here in the United States has proven far more resilient than the vast majority of forecasters were looking for at the beginning of the year. There was tremendous bearishness at the beginning of the year. And then the reversing and the re-rating of that expectation was like the uncoiling of a spring that has allowed the markets to have a bit of a rally off the bottom.
Right. So obviously with a lot of bullish sentiment out there in the market. I want to come back to the Bank of Japan and its shift on YCC. You say it's going to play out over the next couple weeks. Give us a sense. Where do you see it playing out the most? Is it the bond market? Is it equities? Are there certain sectors that are going to be more impacted than others?
Well, it's going to be everything. It's going to be bond market, currency, and equities. All of this, of course, is a complex dynamic that involves multiple economies. And what I'm saying is that this story with where yields go in Japan has got to be put in the context of a global monetary system where you've had a large amount of tightening all around the world, putting pressure on the Bank of Japan.
But let's talk about what you're doing for a second, Kevin. You're overweight on foreign equities versus the U.S. Does that change that thesis at all for you?
No, because if you think about the cause of it, a good deal of the cause of this has been stronger growth than expected in many parts of the world, especially in Europe. But the other part of the more constructive call by Washington Crossing on foreign comes from the fact that multiples around the world are much cheaper than here in the United States. I think we're at something like 20 times earnings here in the United States after a big rally in the first half. Right. The rest of the world is much cheaper. So that's a longer-term play for us.
So you see a value trade overseas. I want to look forward. We have PCE later today. That's one of the preferred inflation gauges for the Fed. How do you see that impacting the market? Again, we saw Jay Powell say the Fed will remain data-dependent. How important is this one, knowing that we have some other inflation reports coming up before September?
Yeah, it's very important because the rise in inflation off the bottom a couple of years ago was very steep as we had a lot of money creation. You had a 40% increase in money supply in M2 during the pandemic. And what we hope to see is that inflation rate would roll over. And it is, but it's kind of sticky in terms of how it's rolling over. If there's a salve in here anyway, it's the fact that the bond market has gotten ahead of this. So already we're looking at over 5%, 5.5% forward expectations on rates looking out a year. And now you've got the 10-year back up, essentially 4% right now. So the market's anticipating higher yields already.